All right, let's jump right in. We all know the crypto market never sleeps. It's open 24/7. But if you've ever traded it, you know it definitely doesn't act the same way all the time. Today, we're going to crack the code on something that messes with even the pros, the weird and sometimes wild world of weekend Bitcoin trading. Believe me, it's a completely different animal, and in this explainer, we're going to figure out exactly why, and more importantly, how you can navigate it.
So does this sound familiar to you? You're watching the charts all Saturday and the price is just stuck, grinding sideways in this super tight, really frustrating range. It's just chop, it is boring, and nothing is happening. Then, right when you're about to call it a night, getting ready for the week, bam! A huge sudden candle appears out of nowhere and wipes out millions in leveraged positions. I'm telling you, you're not imagining it. This is a classic weekend pattern, and understanding the real reason it happens is the absolute key to surviving and maybe even thriving in these tricky market conditions.
So what is the big secret here? Well, it all boils down to one simple question. Who is actually behind the screen clicking the buy and sell buttons? You see, the weekend isn't just a break from work for us. It's a break for the biggest players in finance. And when those institutions clock out on Friday afternoon, their absence completely changes the entire personality of the market. And this slide right here shows that change perfectly. During the week, the market is like a deep ocean. It's filled with institutional market makers, high-frequency trading firms, banks, you name it. They're all playing with massive amounts of capital, which provides tons of liquidity and helps keep prices pretty stable. But on the weekend, poof, they're gone. That deep ocean becomes a shallow pond, and what's left is a totally different crowd. You've got dedicated retail traders like us, some crypto-native funds, and a whole lot of automated trading bots. The whole character of the market just transforms.
Here's probably the best way to picture it. Think of the weekday market like a 6-lane superhighway. Yeah, there's tons of traffic, but the flow is heavy and predictable. One car changing lanes barely even makes a ripple. The weekend market, on the other hand, that's like a quiet 2-lane country road. There's way less traffic, but a single big vehicle, like a tractor or in our case, one whale making a big trade, can suddenly cause a massive, unexpected traffic jam. And that right there is weekend volatility in a nutshell.
And you know, this isn't just a gut feeling that traders have. It is a real, documented phenomenon that researchers call the weekend effect. Multiple academic studies have crunched the numbers and confirmed that, historically, a huge chunk of Bitcoin's positive returns actually happens over the weekend, specifically in that window between the big CME futures market closing on Friday and the Asian markets waking up on Monday. It really suggests there are some unique forces at play when the traditional markets are all asleep.
Okay, let's get a bit more tactical. Now that we get why the market changes, let's see how this actually shows up on a trading chart. What does this low-volume, retail-driven environment really look like candle by candle?
I mean, the data really couldn't be any clearer. Just look at this table. See that massive, consistent drop in trading volume every Saturday? We're talking down over 30% in both 2022 and 2023. That right there is the institutions leaving the building. That's our empty country road. Then look at Sunday. You start to see the volume ramp back up, especially in 2024. That's usually the Asian markets waking up and traders starting to get their positions ready for the weekly open, right before the big herd comes back on Monday.
So this huge drop in volume creates the perfect storm for some very specific chart patterns. First, lower liquidity means the order book is thin. That causes wider spreads between the buy and sell price, making every trade just a little bit more expensive. The market usually gets really choppy and range-bound, just grinding sideways for hours. But, and here's the paradox, this quiet market is also where you get those sudden explosive moves. Why? Because a single decent-sized order can shove the price around. This leads to tons of fake breakouts or stop hunts, where the price just wicks above a key level to trigger people's stop losses before reversing hard. And it's the perfect setup for those nasty leverage-driven liquidation cascades, where one big liquidation triggers the next and the next, like a chain of dominoes falling over.
So here's the most important point to get. Without those institutional giants there to soak up big orders, the market becomes hypersensitive. A single whale can literally make waves that move the entire market. Price action becomes less about deep fundamental analysis and way more about raw human emotion. Sentiment driven by crypto Twitter, and pure technical reactivity, where the price just perfectly follows key levels simply because every single person still trading is watching those exact same levels.
Okay, so we've diagnosed the problem. We know why the weekend is so different, and we know what those differences look like on the chart. Now for the most important part, how do we actually build a practical playbook to deal with this treacherous but also potentially rewarding environment?
Rule number 1, and this is above everything else, is defense. The weekend is not the time to be a hero. First, you absolutely have to reduce your position size. The risk of a sudden huge move just means your normal weekday position size is way too risky. Second, you have to use wider stop losses. Trust me, tight stops in a choppy, low liquidity market are just food for the whales. You will get wicked out of good trades constantly, so give your position some room to breathe. Third, change up your strategy. Instead of chasing breakouts, which are usually fake, focus on trading the range. Look to short near the range highs and buy near the range lows. And finally, and this is maybe the hardest one, you have to avoid overtrading just because you're bored. Let the market come to you.
And just as important as your technical rules is your mental game. Weekend trading is a true masterclass in psychological discipline. The market can be agonizingly slow, and that is a perfect recipe for making really bad decisions. You have to embrace patience as an active skill. You have to consciously fight that feeling of FOMO when you see some small move that you weren't a part of. And you must avoid placing boredom trades just because you're sitting there staring at the charts. Have a plan ready to go before Saturday morning, and then stick to that plan no matter what. Your discipline is your single greatest weapon out here.
And you know what? That discipline can really pay off. There was this one fascinating academic study on the weekend effect, and it found that for some altcoins, momentum-based strategies actually made more than double the returns on weekends compared to weekdays. This just shows that these unique conditions, the crazy moves, the emotional reactions, they do create real opportunities, but they only reward a very specific, patient, and risk-managed approach.
So, after all this, what's the final verdict? I mean, given all the risks and the weird dynamics, is it just better to take the weekend off and go outside? Or are there some genuine opportunities for a trader who's prepared?
Honestly, it really is a trade-off. There is no single right answer for everyone. On one hand, the lower volume can lead to really clean technical patterns and predictable ranges, which can be a great opportunity. But on the other hand, you're constantly fighting lower liquidity, you're paying more for your trades because of those wider spreads, and you have a much higher risk of getting caught on the wrong side of some kind of manipulation spike. So here's the key takeaway. Weekend trading is not for beginners, and you absolutely cannot use your normal weekday strategy and expect it to work. It's a special environment that demands a different strategy, a different mindset, and an almost obsessive focus on risk management. You know, it's like the difference between driving on the highway and going off-road racing. Both need a car and a driver, but they demand totally different vehicles, totally different skills, and a totally different awareness of the terrain. Weekend trading is off-roading. You better be prepared for a bumpy ride.
And that brings us to you. Now that you've got the framework, do you actually venture into the weekend markets? Are you a range trader, or do you prefer to just sit on your hands and wait for Monday when the real liquidity comes back? Let us know. Share your single biggest lesson, the one you had to learn the hard way, down in the comments below. Let's build a playbook together.